There are three major types of business operations or forms of business organizations according to the activities they perform: service business, merchandising business, and manufacturing business. A service provider offers intangible products for a fee to clients or customers. In contrast with tangible goods, intangible products do not have a physical nature. They cannot be seen or touched. Examples of service businesses include schools, which render educational services, hospitals, which provide medical services, and law firms, which offer legal assistance. A merchandising business buys and sells the same goods, meaning what it sells are those goods which it buys. It sells the goods it buys as is. Hence, it is commonly known as buy and sell business. Others refer to it as a trading business. Examples consist of supermarkets, bookstores, and drugstores. A manufacturing business, on the other hand, buys raw materials, not for the purpose of selling those materials, but to convert them into finished goods, after which it sells those finished goods. An example is a furniture making business, which buys materials like wood, paint, and nails, which it transforms into cabinets, tables, and chairs. Only after conversion does the business sell the manufactured goods. Other manufacturers include garment factories, car manufacturing companies, and drug laboratories. I am sure you can add many other examples of each of these forms of organizations according to activities performed. Although accountants prepare, produce, create, or should we say manufacture what is known as financial statements, accounting is not considered a manufacturing activity, but a service activity. The Accounting Standards Council, the predecessor of today's Financial Reporting Standards Council, further stated that its function is to provide quantitative information, meaning information in the form of counts or numbers, primarily financial in nature. In other words, information is expressed in terms of money, about economic entities, or the different businesses and other organizations or units within society which produce, distribute, and or consume goods and services that is intended to be useful in making economic decisions. Another definition of accounting came from the Committee on Accounting Terminology of the American Institute of Certified Public Accountants. Here are mentioned the 4 phases of the accounting process. Accounting is the art of recording, which is the first phase, classifying, the second phase, and summarizing, the third phase. In a significant manner and in terms of money, remember the financial in nature thing we encountered a while ago in the first definition of accounting I discussed? Transactions and events, meaning the happenings in the life of an economic entity, which are in part at least of a financial character. Again, the same idea is conveyed here in monetary terms. and interpreting, which is the fourth phase, the results thereof. Again, the words encircled in blue are the so-called 4 phases of the accounting process, which will be discussed in detail in another video. The American Accounting Association defined accounting as the process of identifying, measuring, and communicating economic information to permit informed judgment and decision by the users of the information. So the same idea we learned in one definition of accounting a few minutes ago about its function of providing information useful in making economic decisions is repeated here. Now, what does this term identifying mean here? It pertains to the recognition or non-recognition of business activities as accountable or recordable events. As already mentioned, the first phase of the accounting process is recording. What are recorded by accountants? Transactions and events. However, please note that not all transactions and events or happenings in the life of an entity must be recorded. A business transaction or event must be recorded only when there is an exchange of values in terms of money. In other words, something is received, something is given up. A transaction to be recordable must have dual or twofold effect on the accounting elements. More on these accounting elements in another lecture. And of course, just based on the definitions of accounting, the exchange must be quantifiable in terms of money. Therefore, in the recording phase of the accounting process, an accountant must be able to determine which transactions must be recorded and which ones must not be recorded. That is what is referred to in this definition of accounting as identifying. Measuring is the assigning of monetary amounts to the accountable economic transactions and events. Because again, remember the phrases we have already encountered: financial in nature and in terms of money. Communicating refers to distributing the financial statements of the entity. To whom? To the users of accounting information. Those users are known as stakeholders, or those who have an interest in the business. Please take note of the spelling, because some claim there is another term with a different spelling but the same pronunciation. Stakeholder, or one who holds a stake, such as a beef steak or burger steak in a restaurant. This is not what we talk about in accounting, but this one. Stakeholders, those who hold an interest in the business. Stakeholders may be divided into two groups: the internal users and the external users of information. From the word internal users are those who are within an organization, meaning they are part of a business entity, while external users are those outside of the organization. Internal users include business owners or investors. Although the words owner and investor are not exactly the same, since there are several forms of investing or investment, I combined these two, owners and investors, into one group of internal stakeholders, because becoming a business owner is a form of investing, and so an owner is considered an investor. If there is one stakeholder who should be the most interested about a business organization, it must be the owners. They definitely want to know if their business is earning well or not, whether they will increase or decrease their investment. If it is earning well, owners may decide to further expand their business operation. If not, then they must find a way to enable it to improve its financial performance. Or in the event it continues to incur losses, they might just want to close it down and pursue other endeavors. Employees are another group of internal stakeholders who are also interested to know if the company is earning well or not, if it is stable enough to provide them with job security, salary increases, and better benefits in the future. Let's assume you were an employee of a certain business. Based on its statement of comprehensive income, which is one of the financial statements, you learned that the company has been losing money for the past few months. Do you think it will be capable of giving you the amount of compensation you desire and deserve in the future, and providing you with better benefits? Most likely, your answer is no. The business may find it difficult to comply even with the mandatory benefits required by law. How much more the non-mandatory benefits? In that case, you may decide it is time for you to say goodbye, to resign from the company, and transfer to a higher earning and more stable corporation. Managers are also internal users who have several reasons for being interested about the results of operations and financial condition of the business entity. One of which is because the organization's performance is somehow a measure of their own performance as managers. For instance, the revenues of the business do not seem to improve. The marketing manager may not be doing his job well. Well, I am not saying that it is always the fault of the marketing manager when a company does not seem to sell its products well. But a manager should ask himself why. Because the performance of the management will most likely reflect on the result of the operations of the business. Managers also need accounting information to be able to make certain decisions, like whether to borrow money or not, to suggest the expansion of the business operation, or stop selling a particular product, or add new products to sell. Let's proceed now to the external users, or those outside an organization. First, the creditors, who may be classified into two. The suppliers, who need accounting information to determine whether or not to sell goods on account or on credit to the business enterprise. And the lenders, who must decide whether to lend their money or not. If, based on their assessments of the financial statements of the business, it is creditworthy and has the capability to pay its obligations, they would most likely sell on account, meaning deliver goods to the enterprise even without receiving immediate cash upon delivery, or lend money to the business entity. Customers may need to assess the financial position of an organization to determine if it can be relied upon for continuous supply of products even in the long term. Because if the supplier is not in good financial condition, it is very possible that in the future, it may not be able to supply its customers anymore with the products they need. In that case, the customers must start looking for another supplier. Let's say you have a construction business somewhere in the Visayas or Mindanao, and you currently only have one hardware store from which you buy. The question is, will that hardware store still be in operation a few years from now? Or will it still be able to sell to you the materials you need? Because if not, what will happen to your business by then if you do not have another ready supplier? In addition, customers need to be assured that the business enterprise will be able to honor its warranty obligations to them. I'm sure you know what product warranty means. For instance, you purchased a certain item with a 1-year warranty period, which means that if the item malfunctions within 1 year from the date of your purchase, you may return it to the seller for replacement or repair, free of charge. But what if, after just a few months after purchase, the company already closes down? Do you think it will still be able to honor its warranty obligation to you? Of course not. Another reason why customers are considered stakeholders or users of accounting information is because they want to know if the company sells quality products at reasonable prices. Not to be outdone as a stakeholder, an external stakeholder, is the government, because it needs funds to use for the benefit of the public. That's why it wants to verify if the business organization has been paying the correct amount of taxes. Likewise, the government wants to find out if the entity has been operating in accordance with all other applicable laws. The general public also takes an interest in a business organization. Does the entity practice what is called corporate social responsibility? Does it operate without doing damage to the environment? Does it give back to society in the form of good salaries and better benefits to its employees, support to the government, especially during times like this of COVID-19, as well as to other social and charitable organizations, assistance to uplift the lives of the underprivileged, such as providing scholarship to the poor but deserving students? Or does the business entity keep for itself and its owners all profits earned, no matter how high? And of course, the prospective or potential owners or investors. In contrast with existing owners who are internal stakeholders, potential owners are not yet part of the organization and hence are still considered as external stakeholders because they are still thinking whether to make the investment or not. Do you know that you can become an owner, at least a part owner or one of the owners of large corporations like San Miguel Corporation, SM, Jollibee, or even Facebook, Zoom, and Apple, as long as you have the money? Actually, for as little as 5,000 pesos, you can open an online stock brokerage account and be an owner, at least one of the owners of a corporation or even corporations. But before you can wisely decide what corporations to invest in, you must know something about your prospects, especially during times like this, when many businesses, even large ones, have been losing money already, with some even closing down several branches. And it seems the current situation is not about to improve soon. And talking about being a business owner, in the Philippines, there are different forms of business organizations according to ownership, namely sole proprietorship, partnership, corporation, and cooperative. A sole proprietorship or single proprietorship is owned by only one individual, called simply as owner or sole proprietor. A partnership is an association of two or more persons known as partners who bind themselves to contribute money, property, or industry to a common fund with the intention of dividing profits among themselves. Corporation is defined in the Revised Corporation Code as an artificial being created by operation of law, having the right of succession and the powers, attributes, and properties expressly authorized by law or incidental to its existence. Before the effectivity of Republic Act No. 11232, otherwise known as the Revised Corporation Code of the Philippines, which was signed by President Rodrigo Duterte on February 20, 2019, a corporation may be formed only by at least 5 but not more than 15 incorporators. But upon effectivity of the law, even with just one owner, called stockholder or shareholder, may already form and own a corporation known as a one-person corporation. And a regular corporation may be formed by 2 to 15 incorporators instead of the previous 5 to 15 under the old corporation code. After incorporation of a regular corporation, however, just like under the old corporation code, it may then be owned by an unlimited number of stockholders in case of a stock corporation or members in case of a non-stock corporation. Please do not confuse stakeholder with stockholder or shareholder. Stakeholders are those who hold an interest in an organization, one of which is the stockholder or shareholder. All stockholders, being owners of a corporation, are stakeholders, but not all stakeholders are stockholders. Please take note of that. And note also the difference between incorporators and stockholders. Incorporators are those stockholders or members mentioned in the Articles of Incorporation as originally forming and composing the corporation and who are signatories thereof, while stockholders or shareholders are owners of a corporation. In short, all incorporators are stockholders, but not all stockholders are incorporators. A cooperative is owned by a group of at least 15 individuals referred to as members in case of an unincorporated cooperative, or stockholders if incorporated, who are also beneficiaries or customers of the economic or social endeavor. An example of a cooperative is a group of employees of a certain corporation who decided to establish a small convenience store inside the premises of the corporation. Those employees who own the cooperative also become customers of the cooperative as they also buy from the store, together with other employees of the corporation. That's it for part 1 of this lecture series on the introduction to accounting. Thank you for watching.